Hey everybody, Lawrence here. And guess what? It's Thursday, and you know what that means. Well, tomorrow's Friday, so it means that too. But also means that we have a very special guest with us this evening, live and direct from London, and he has a really nice green screen background that you'll be able to see. We have Rob from Plend, who we've had on the stream before. It's probably been a year. I don't know exactly how long it's been, but we'll get him on in just a minute. I want to say thank you to everybody for tuning in, spending your hopefully not longer than an hour with us this evening. By the way, if you notice in the corner of the screen, we have a new camera set up for everybody that's a dog lover. This is introducing the premiere of the Harley Cam. So now she has her own special camera focusing on her. She's been asking me for a while. She wants to be star of the show. So there you go. We've got a new camera set up just to show this is a real vlogcast, whatever you call it. We keep it real here. So thanks for joining. Please hit the thumbs up, subscribe to the channel, all of that good stuff. And I hope you guys are all well. If you have any questions or comments, Rob honestly is one of the most transparent, down-to-earth people that I've met in this business, and he's always happy to answer questions that you have about peer-to-peer lending or about Plend or what they're up to. So put them in, and we'll do them at the end as we always do, have a Q&A session. And I hope you enjoy the stream. Let's bring Rob on. Where are you? There he is, the man himself. Let's unmute him. Hopefully, there we go. How you doing today, Rob, this evening? Can you hear me? Oh, wait. There you go. I got to unmute myself. You didn't hear any of that, did you? I just gave you such a nice intro, and you absolutely heard none of that. So that was really funny. I was just saying you're one of the most down-to-earth, transparent people I've met in this business. And for everybody who's watching to ask whatever they want about Plend, about peer-to-peer lending, about your love life, whatever it is they want to know about. So, and I was also telling we've set up a brand new camera here that just focuses purely on the financial thing mascot you can't see because you're on Skype, but it's a camera you see down there in the background with the little mascot Harley. So she's got her own camera now, and she's loving life. So, but how are you doing, Rob?
Yeah, good, Lawrence, and fantastic to be here. Thanks for having me on. And I did miss the intro, so you could have said whatever you wanted about me and the honest truth if you had to. But no, glad to be here, and also glad to reconnect after all this time as well. You've sort of been aware of us from probably the beginning or very early stages when Plend was a very different proposition. So it's great to kind of not go full circle, but sort of connect at a very different time and a different play.
Yeah. Well, we've kind of watched you evolve. Hopefully you can hear me because I think you might have frozen a little bit. Can you hear? Oh, hold on. We lost him.
I can on my end.
Okay, there we go. Lost you for a minute. But we've kind of been through this evolution of when I first met you and you were working on launching Plend. It was just a idea, a little twinkle in your eye, and now you've come full circle to this actual real company. And Rob just said something very funny to me. I don't know if I should tell you this, but I'm going to tell you anyway. He said, "I really don't know what I'm doing, Lawrence," and I think it was tongue-in-cheek, but to some respect, Robert, he'd never done anything like this before, so it's cool to see him be able to develop this business. So we're going to talk peer-to-peer lending with Rob. We're going to ask him about Plend. We're going to ask him the all-important question that everybody wants to know is when is Plend, or are they going to become open to retail peer-to-peer lending? So we'll talk about that, and we'll get his thoughts on all the different stuff that you want to know about. So let's talk about Plend. You've introduced kind of this new product, this open banking lending, consumer lending. If you haven't been to Plend's website, by the way, go check it out. It's Plend, plend.co.uk. You can see right here. Their consumer lending, they offer all kinds of loans to people at, I would like to think fair interest rates. So what's the reception been like to Plend's loan offering? Because you're still very new. I mean, when did you launch?
Yeah, so no, and you're right. We are extremely new. So we only got regulated, fully authorized by the FCA in April of last year, so 2022. And since then, we've had close to 70,000 applications for credit, which has been absolutely mad for us. So the reception from a borrower standpoint has been immense. We've since launched the Plend proposition on 9 different sort of price comparison websites, including one we call it embedded, but essentially someone else's app. There's a Plend product embedded into their app, and we acquire customers via their app essentially. So it's someone else's journey, but we're in that journey, and then you can get a credit product out of it. So yeah, from a purely sort of borrower perspective, it's been amazing, almost too amazing. And as I was sort of saying to you before this, I'm not going to lie, we're a small company. It's broken some of our processes, it's broken our platform, just the sheer number of applications sometimes at wacky times of the day or in the week. Christmas, not Christmas Day, but around Christmas was particularly intense for us. We had launched a new product, maybe stupidly, and we had about 3 times as many applications sort of during that period. So it was a busy time for the Plend team over that Christmas break.
When you're saying it breaks the platform, you're saying that you just get too much data overload on the servers, and the website couldn't handle the amount of applications that you were receiving?
Exactly. And it comes down to the open banking journey here, and that's what's quite important about it. So every customer at Plend has to go through an open banking journey. It's a bare minimum requirement, and it's for a number of reasons. A lot of it is fraud and identity. So before you even get to us giving you a risk assessment and sort of judging your affordability for a product, we'll need to work out who you are, where you've come from, the journey you've been on to get to Plend. That's really important to us, and how you're at risk, how much friction you've had to go through. And then does your bank account have enough real data in it to make a decision, i.e. is there income, is there core expenditure coming out of it? And if there isn't, we have to keep asking for more and more either bank accounts or other financial products that you might have. In some cases, we might ask you to connect your payroll data, whatever we need to get at least a bare minimum level of comfort that you are a real person and have a real job and have some stability, which we can then take you on to the next stage. That process is about 5 different steps in that process. The sheer number of transactions we need to analyze over that process is immense. It can be anywhere from 10,000 to 20,000 transaction lines per customer that we need to then analyze, and then quickly return a decision back to those customers. So when that's sort of happening with a couple of thousand at a go, or at least in an hour's time, it can really overload us in our sort of hosting capacity. I think any platform would struggle with the sheer number of volume in those circumstances. So it's been a lot of lessons for us in terms of not just running a lending platform, but just purely running a digital first platform that needs to handle the sheer number of transactions and data it needs to analyze, and being able to be robust enough to handle that, have the right infrastructure in place. We've had to redo our code on our sort of core infrastructure a couple of times to make it more efficient. That's been a bit of heavy lifting from the tech team. But now we're in a place, looking sort of forward now, we can handle that volume, and we can handle that sort of aptitude of customers. We want to be a UK-wide platform, and to do that, we need to be in that place and be ready and handle that operationally. So, yeah, the last sort of 9-10 months of being regulated has been an absolute test for us to get to that level and become a mature business.
You've got to get off that £13.99 a month GoDaddy shared hosting. That's the problem. It's time to upgrade the hosting account. That's really exciting.
That and a few other bits, but yeah, you are.
And
you're right there.
So when you came into when you first contacted me early on, and your plan was to become part of this peer-to-peer lending sphere inside of that sector. So I want to jump right into that right now. Is Plend going to be still on that path of offering retail peer-to-peer lending, or has that changed? I know you're working out with some, I think Nationwide, was it, or you were doing something with them. What's going on with that? Will people be able to take loans through Plend on the investor side?
It's a great question, and one I get asked regularly by lots of different people. So yeah, for context for the viewers and your sort of your followers, subscribers, we founded Plend back in 2020. The original concept of Plend was to be a fully diversified sort of peer-to-peer marketplace where you could pick the underlying loan profiles for consumer. So akin to what you see in other asset classes, from property to business loans, we wanted to do that for the consumer space. It hadn't properly been done, or at least not done at scale, and that was sort of the initial gap that we were looking for. Along the journey, we got originally funded by Nationwide Building Society back in April of 2021, and what that sort of catapulted was this journey down open banking and the origination side for the borrowers. And what we'd found via that journey was that there was a myriad of problems and customers missing out, and the plan was to finance them by these kind of the sort of marketplace of peer-to-peer loans and allow retail investors and other groups to fund those loan contracts. However, the funding from Nationwide and then the interest that we got from that and the progress that we'd built around the original, we call it the Plend score, that's our alternative credit model, got us funding from other groups, VCs and other institutions, and more recently we've taken funding from a German bank to really start to ramp up the borrower side of our proposition. And that kind of consumed us, and it still consumes us to this day. We are still regulated as a peer-to-peer lender. We can technically open up the platform to retail. I'm sure you're aware, and all the subscribers are aware, that there are a lot of challenges currently on the retail side for P2P, not necessarily because of historical sort of issues and the reputation in the industry, but the FCA are sort of really clamping down on financial promotions and obviously the incentives that you can give, which did drive a lot of initial business or initial, attraction, to the asset class. It's still an option. Right now, we have a mix of different funding sources. We have a large amount of high net worths and family offices who fund a lot of the loan contracts. And then we, more recently, this German bank. So we do have a mix of different funding sources. And to be honest, the focus, and still is the focus, is on the origination side. It is very hard to run both sides of a P2P to have what is a very, very robust product for retail investors to pick and choose, or to at least, even just withdrawing funds and having live data moving around and thousands of accounts that are live and then offering an iFISA or something like that. There's a lot of work there, and we're not at that level yet, if I'm honest. We've spent a lot of our time and effort. We're only a team of 25, and the majority of that team is focused around sort of risk, data, operations, customer support when it comes to the borrower side. So I personally think there's a space for retail to come into our product. I don't know whether we can do that ourselves, just given our infrastructure and given our capability. However, we are exploring some really exciting partnerships with platforms that have a retail offering. Some well-known ones in Europe, for example, which I'm sure a lot of you guys will have investments in currently, in which Plend loans can be parceled off and sold via these platforms. We'll offer obviously some form of buyback guarantee and protection around them, but essentially there's a way in which retail investors can still access the Plend proposition, the Plend asset class. But I just don't think we're in a point where we can offer it on our own platform, or at least our own infrastructure. So I'm a finance geek, I'm a P2P geek. I would love to see this to be opened up. It's just not, unfortunately, in our bandwidth right now. But it's a great question, and I would like to see keep asking the question as well. Like, don't let me get away from giving an answer now and then.
You'll never be invited back now because you're not peer to peer. So we have no use for you anymore. No, just kidding. I mean, honestly, I figured that if you have enough money from other institutional lending lines, I think one of the biggest problems with retail is just dealing with the amount of customer service that's involved. And I imagine you have that on the borrowing side, and then it would be like you were taking on double. So, because you're new and growing, I definitely understand that. Although I don't really have nice things to say about the banks after seeing this debacle that's happened recently, and my trust in the banking system was already very thin to begin with. I try not to keep my money in the banks, and now seeing what's happened over the last couple of months, I really don't subscribe to being a fan of the banks at all. But I get it why you'd have to do that. So.
Well, I 100% agree, Lawrence. And the reality is, look, for me, I'm an entrepreneur trying to maximize the margin we get from these products. We create an asset class, a Plend loan, and we're trying to get the best deal, the best financing deal. And I will be honest, like institutional funding isn't necessarily that great. It's not that it's better than retail. There are a lot of costs that come with it. Not to mention the obscene fees that you get charged just to physically unlock some of these financing arrangements. So, it's not cheaper. It's not necessarily more efficient. There's maybe a scalable aspect there. You can use more of it quickly. But our first financing facility, I have to be careful what I say. This is public, isn't it? But our first
they're not going to see it. Trust me, they're not going to see it.
No names mentioned. It was a US credit fund. They moved very quick, and they're a fantastic partner to our business. But they have blocked our facility on 3 different occasions, and just because of reporting or trying to catch up on things, or because of this banking crisis in the US, there was initially a concern. Everyone was being a bit cautious. They were sort of cutting back on how much you could borrow. But legally, I was allowed to borrow up to quite a large amount of money at a moment's notice, and that's what we could do. But as soon as the market got jittery, you realize that's all a bit. It's not completely true. Even though legally it's there, you're not going to go and sue your debt funder, because the reality is you need that funding, and those arrangements take a good 3 or 4 months to execute on. So you can't just go and refinance that and find another source of funding overnight. It's impossible. But keeping a diverse set of capital for a platform like Plend, absolutely vital. And we do have at least 40% of our current financing base is technically under that P2P banner, under that same regulation in the UK. And there are a lot of individuals in that, but they're just behind the scenes. We agree sort of a fixed note with them with a fixed return. We have a buyback built into that product, and it's just very, very low admin for our team, and that's it. And it's very easy to work out the return from that. We're not trying to allow you to pick and choose the different assets. You just get a blended return across the entire portfolio. So I capital sources will change and they'll flex, and I will try to maximize and optimize where that comes from. And hence why launching sort of these retail parcels onto these platforms in Europe is a way of us diversifying that and keeping that flexibility without having to manage and control that relationship with the retail investor, which, as you say, can potentially be quite costly. But the jury's out on whether it's better or worse. I've now experienced both. Well, I haven't really experienced the full retail piece, but I've definitely experienced the institutional piece. And I'm not necessarily going to say it's clean and fast and better. There's a lot of ones
different. Yeah, and like you said, they can pull the credit line from you on a moment's notice and really leave you kind of stuck, which is the con side of it, but not as in being conned, but pros and cons side. So at least, one good thing about having you on and this information, I think it helps people on the investor side, even though you're technically not peer-to-peer lending, but they can understand the process that you go through when you are screening people to lend money to, which I always find it quite fascinating because you're on the consumer lending side. So one of my questions that I wanted to ask you is, you said you've lent, did you say you'd lent 100 million, or you said something about 100 million?
We've originated about 107 million over the last 10 months.
Okay, so 107 million to consumer borrowers who need some quick cash. What have the default rates been like on those lending programs that you've done? And have you had to chase people for repayment? What has that been like? Because your open banking system is supposed to really improve that side of things, right? And how much the risk is and the default level. So how has that been for Plend?
Yeah, it's a good question. And it's an interesting answer I'm going to give you. So we've only had one actual default, which sounds crazy. And it's because we haven't been operating that long. So in order to have a substantial level of defaults, you need to have a substantial level of time to pass with that book. Mm-hmm. So only one loan to date has actually defaulted formally.
That's good.
It's great, isn't it? In terms of like early arrears, which I think is more important when you look at a platform like this and where the bad debt rates or the loss rates could go, we're sort of around the 3.5% mark, and that's sort of where we want to get to in terms of loss rates annually. We want to be at sort of the 3.5-4% loss rate level, And the reason for that is because we want to make sure that we're we're lending at the right volume and the right level. If we were lending too safely and we had a very, very low default rate, this would basically mean we're not lending enough volume. We're not actually doing this right, and we're not seeing any correlation between risk and performance. So we want to have a level at which we can project and we can hit. That's the most important thing, and I'm sure you and everyone else that's on this knows this. You know, it's all good having a default rate of 4% or 10% or 3%, doesn't matter. It's better. It only matters if you projected that 2 years ago and you were like, I can tell that this cohort is going to perform in this manner, and that's how good my risk engine is by the result of this projection. So projection is around 3.5 across the entire book. Obviously, different cohorts have different rates and different delinquencies attached to them, but that's what we want to get to. It's relatively on par with the rest of what you would call kind of near prime Europe consumer, sort of that kind of space. And it's also partly driven by the financing arrangements we have with third parties. So with the German bank, for example, we're sort of expected to be around that kind of level based on their financing. So there's nothing that's particularly out of the ordinary. You talked about sort of the open banking model being important. Like, absolutely. What we're trying to do is sift through those applications and basically pick out early warning signs that you wouldn't get from traditional credit bureau data. And what I mean by this is, do you have an actual job? Is there actual salary that we can see coming through? Is there reliability around how you pay your subscriptions? So yes, you might have missed your credit card payment, which I can see from the credit bureau, but are you missing other payments as well? Are there other forms of vulnerability that's been missed out? Are you gambling a lot? There are other expenditure items with buy now, pay later, which aren't clear or visible to credit bureau data, which is also, by the way, 90 days out of date when the time you pull it from a credit bureau on an individual. So you don't really know what's happened in the last, this kind of, we call it a data blind spot. You don't really know what they've been up to the last 30 to 60 days. So that's really, really vital for screening out that vulnerability. And it doesn't mean that it decreases defaults. What it means is that we can lend to more people that are good quality. There'll still be defaults, there'll still be performance, because we still need to hit that 3.5% mark. But it means we can increase that ratchet up that volume to a level which is far, far greater, and hit sort of a more commercial position for us overall as a business sooner by virtue of that. So it's like that side is performing really, really well. The early win for open banking is fraud. So doing your KYC and doing your fraud with a mix of open banking, credit bureau data, and personal data from the consumer, verifying and triangulating all of that, massive, massive win. We've had no cases of fraud at all. First and second case fraud. That's been a massive win for us, and to the point where Nationwide, who are one of our investors, are already working with us to take some of that technology off us. Not stealing it, licensing it, I should say, to use for their own processes internally at Nationwide, because that has been a massive win for open banking, or at least our system of open banking. In terms of actual loan performance and that piece, 9 months, 10 months is not enough for me to tell you that we've cracked it. I'd love to tell you we have, but you need a good seasoning of 4 to 5 years, a few more cohorts going through and seeing that kind of end-to-end performance. You know, in that point in time, I can tell you, Lawrence, I've smashed it. And by then, you know, it's a very different story about whether a P2P or not. We'll be absolutely performing and we'll need to raise money ever again. But until that point, you know, there's some experimenting with this and this model. It is still very, very new. There's probably only one other lender in the UK, full stop, that has explored this model with enough data, and they have maybe 2 years ahead of us, perhaps. But aside from market adoption, there's over 250 regulated consumer lenders in the UK. There's only really 2 or 3 of us that are actually properly doing this now end to end. So people are looking at adopting it and sort of sprinkling it into the risk matrix for most of their decision making, but we've not seen this happen at scale, and where every customer has to go through this journey and every decision is underwritten by open banking. It's a big risk to take, and most banks and institutions haven't taken that leap yet, but they will. I'm confident in 3 or 4 years' time we're going to see mass adoption into this space, and there's already early signs of this happening. So yeah, exciting times.
You're ahead of the curve.
That's the plan. We've got enough data. We've made maybe enough mistakes early on to learn from those mistakes, and then to basically triangulate some good results in 3 or 4 years' time. That's ultimately the play for Plend at this stage.
So I should have asked you this at the beginning. This is a rookie mistake when it comes to interviewing people. For everybody who doesn't know what Plend is, because I'm sure there's going to be people, I do automatically assume that everybody knows what Plend is. Give me a quick, 30-second to a minute summary like I was 10 years old and tell me what exactly Plend does.
Yeah, no, absolutely. So in the name, we lend money. We lend money only to consumers. Currently, we're regulated in the UK, and the type of money we lend is term loans or fixed term loans. So essentially, you borrow for 3 or 4 years, up to £15,000-20,000, and you repay it monthly via a fixed payment. So it's very simple. There's no kind of credit facility. You're not reusing the funding from us. You can't use it in payment, so it's not a credit card. It's very simply, I want to borrow 15-20 grand, and I want to repay it over 4 or 5 years. Traditionally, it's a product that banks will provide. You don't see it as common in non-bank lenders like Plend, because it's very, very prime, and it's also a bit higher risk. So when you're going to lend 10 or 15 grand, you need to be sure you're going to get it back, especially over a longer period of time where there's more chances of the customer, losing their job or not being able to repay that product. The beauty of a credit card is you're kind of constantly getting repayment cycles, and generally you're not always exposed all the time. That's not always true, but it's a bit safer generally to run that. So with Plend, we're taking a big risk doing a big bank product, which normally is a very prime. We're offering it to a near prime audience. So this basically is customers that we feel are as reliable as prime. They have good stability factors such as their income. They pay all their bills on time, and we would like to lend to them like a bank would. We charge a relatively affordable rate. It's not prime. It's around an average of 16 to 17% APR, but it's far more attractive than if you had to get a shorter term alternative or had to borrow from an alternative lender. We're about half the price, if not more in most cases, compared to our competition. And the reason why we have so much demand, it's not necessarily the rate, it's just the product type. It's very hard to go and find 20 grand if you're not getting it from a bank. That is a very difficult product to achieve or to obtain. And we need to be very confident on our end that we can write risk and be safe. So that's where the open banking element comes in. So Plend, we use open banking data. What this means is that you as a customer, as part of your application process, will authenticate, go via your bank level authentication on our platform in a pop-up. You will essentially consent to sharing at least 12 months of transaction data from your bank with us. Generally, we'll ask for 2 or 3 bank accounts. We need enough data from that sort of picture to sort of paint to write a product. So that authentication process is vital. We make everyone go through it. There's lots of wins to that. Mainly it's fraud and other aspects, but we use that data as the basis of our decision making. It generates what we call a Plend score. That's our alternative credit model. And that Plend score dictates on how much we'll lend to you, at what rate we'll lend to you, and how long we'll lend to you. And what we're trying to do at Plend is correlate that Plend score to performance. So as we lend more and more over time, that Plend score should correlate to some form of performance around, are you paying on time? Are you missing payments, delinquent, or if in the worst case you're defaulting? And we're trying to correlate that over the next 4 to 5 years. That's the ultimate pitch with our business.
And then just Rob, real quick, somebody's asking, what does prime mean? Just explain that very quickly.
Good question. It doesn't mean anything.
What's a prime lender supposed to be?
There isn't really like a sort of generic rating system. There's no at least regulation around this either. It's just a concept or a term that's used in the industry for what you would deem someone who is very, very safe. Traditionally, a prime borrower who's going to a bank and asking for 20 grand has a mortgage in most cases. If you as a lender can see there's a mortgage and you're paying your mortgage back on time, that's a very quick decision you can make and say, look, you're generally in the prime bucket. Provided you're making all those payments on time, you're prime. There is a credit score. Everyone has a credit score in the UK. There's multiple credit scoring agencies. There are generally scores that you would see as being kind of in the upper tier, which you might classify as prime. However, there are other factors such that the mortgage that you need to correlate first before you can make that decision. But that bucket, it's a broad term that internally, we might all have definitions on, but it's generally a mortgage owner and homeowner, has a mortgage and being very reliable, has a good job.
Somebody you consider safe, basically.
Yeah. But
Safe,
even me explaining this makes me realize it is a kind of made up term. Like there's no, it's not like someone like Standard and Poor's is given a AAA rating. Not that necessarily means anything either, but there's no sort of external rating of this type of this model.
Yeah.
What we call near prime, it's all semantics here. essentially near prime for us is prime. We think the customer is rock solid. We think the customer should be prime, but for whatever reason, they're not getting a prime product from a bank. They're not getting a low APR from a bank, and they've come to us for that reason. If they've come to us and they've got a prime credit score and a prime rating, there's something's wrong with the credit scoring system. And actually, what we call it an honest click at Plend. There's almost like a bell curve here. Our sweet spot is people have credit scores that are sort of in the middle. If your score is too prime, there's something going on we're not sure about. You may have lost your job, you may have excessive gambling, or some other factors that are not shown on your credit file, and therefore the credit sort of bureau doesn't know what's behind the scenes. So we actually decline about 10 to 15% of people with prime credit scores. On the flip side, we decline people that have subprime credit scores. But what we can do is probably boost that score internally on our end if we can see you've got stability, you've got a good job, and we can see you're paying all your payments on time. So there's sort of no real definition between prime and near prime and subprime. It doesn't really mean anything. The main thing is we find a group of customers that no one else wants to lend to at a good rate, and we lend to them, and we think they're good credit risk on our end. That's the bet that we're making when we see these customers come through.
Yeah, okay. So I've always been curious about this. So I come to your platform, right? I get approved for a loan, and then how do you get the money to me? Is it sitting in a bank account somewhere? You just press a button because you don't technically have the money. You're getting it from another institutional. So what do? Send them an email and say, hey, send 20 grand over to Lawrence here in this bank account. How's that work? Just curious.
No, it's a good question. I mean, so from a regulatory standpoint, that's sort of what has to happen. That has to be, it's a bilateral product. So you have to be able to show that there's funding going from one source to another. And Plend is not lending off its balance sheet. It's not literally taking money off our balance and going into those consumer products. The reality is much different. So we work with a custodian banking provider called Modular. Essentially, there's a myriad of different wallets that we run on the back end. It's relatively complex, but it's a very, very cool system, and it's completely automated. So whenever there's a request for funding and it gets approved, there's basically a call or an API goes up, and essentially there's pots of funding that are already sitting in the name of the lender. So it's already legally their funding. We sort of ring-fenced held on their behalf, and it just draws a portion from those wallets. So effectively, well, from a regulatory standpoint, you, Lawrence, are being funded by 10 or 15 different people, and it's coming from their accounts. But the reality is Plend has already managed that and already handling that, and it happens instantly. And you would never see the difference. You just see Plend, you pay back Plend. There's no, you don't see behind the scenes of how the sausage gets made.
That's so cool.
But well, it's cool, but we're not the only ones doing this. This is sort of where the industry has sort of moved to. It creates the same effect of going to a bank, but the reality is it's all sort of ring fenced and held by these modular wallets, and those wallets also have FCS protection, so it is insured. And most of our investors are above the insurance limit, but it is insured by that as well. It is a regulated bank account that we're holding the money in. What was I going to say to this? In terms of paying you out, yes, and then in terms of paying us back, it's the same as a bank. You set up a direct debit with us, it comes out monthly, and that's sort of it. It's actually a lovely product. I love it from a credit perspective. When you do facilities or buy now, pay later, anything like that, it's very, very short term. You're sort of going for mass amounts of people. You're trying to get a lot of people to do the product, very small amounts, spreading risk, which is great. But actually, it's a massive hassle operationally. There's payments, there's live data points all the time being pushed back to you. With us, once a month, we get a payment. If you don't pay us, we keep trying to retry the direct debit. And if that doesn't work, there's multiple sort of automatic tiers of communication. There's text messages that will go out. Generally, we find in the first 30 days, if we can get communication, about 99% of the chance we'll get you to repay us. So as long as we get comms, a customer repays us. Most of the times they miss a payment because the direct debit was in the wrong bank account. They didn't have the salary came in a day too late or something like that. It didn't quite line up with the money coming into their account. So it wasn't set up correctly on our end. So there are things like this which you can easily rectify, and that's the vast majority of your early arrears you clear out straight away. And the remaining sort of 15 or 20% that don't get picked up by that in the first 30 days, those then have to go into more severe collections, and that's where you have to unfortunately threaten to, like, leave a bad mark on their credit file or transfer them to a third party. And at that point, you're going to whittle that down to that 3.5%. So you're taking them through a waterfall journey, you could call it, and then you're sort of planning, projecting to get it down to what you feel is a reasonable number, which for us is that 3.5% mark.
Yeah. Do you ever look at these institutional funding lines that you have access to and say, "Whoa, there's 20 million in there"? Does that just blow your mind? I always ask people that work for banks, bank tellers and cashiers. So you get to look into everybody's bank accounts. Does it blow your mind when you see somebody who's got just 10 million cash sitting in their bank account? I don't know what that's like. I'm lucky if I've got 100 in my bank account, £1,000 sitting in there, because it's always going in and out. So is that weird? Does that blow your mind when you see those type of numbers, or you just get numb to it?
As you're sort of saying, is it really there though?
It's just digital.
This current banking crisis, it tells you it's there, but is it actually there? Does it blow my mind? Not so much, because especially with institutions, they have different processes in place. So they don't always have the entire facility is never sitting in one account. They can deploy a maximum $1 million into, well, the different institutions have different rules, but our main funder can only have $1 million sitting in one of our wallets in their names at any one time.
Just a million. Just a cool million.
Yeah. Just a cool million, exactly. but there's different sweeps. So it's all automated. So at 3 p.m. every day, everything must be sweeped back to the original holder. So any funds that are sitting in our name have to be swept back to that customer. And we then got to tell them, for this month, we need, I don't know, circa 150 from you. And then we can draw that down, and then we can redeploy that into loans that would originate. So there's a bit of a cash management piece. I don't know what you call it, financial operations. There's different terms for it, but essentially you're sort of managing kind of almost like a bank, actually, the kind of depositors and the sort of liabilities. Well, that's the liability, the assets, the loans. You're sort of managing those kind of two sides and sort of those flows and making sure it's all, you got enough there to kind of satisfy the other. Never got in a situation where it's properly been an issue so far, but yeah, when you get to scale, yeah, you need a whole team managing that process. At the moment, it's just one person, or 2 people technically.
Sounds cool though. Sounds cool to be able to look and see these £1 million wallets. But so let's talk about peer-to-peer lending quickly, because that's what everybody wants to hear about here. And you're not going into peer-to-peer at the moment. You may do in the future. Who knows? Personally, I wouldn't blame you if you didn't, but because you got to deal with all of those retail customers. Some are a joy, some not. What do you think about what's going on in the peer-to-peer lending space? And first of all, do you invest in peer-to-peer lending yourself still? Because I know before you were dabbling, checking out the competition. Do you still have money invested personally in peer-to-peer lending? And if so, if you want to throw some names out there about who you like, who you think's doing a good job. Other people have done it on this podcast before, and again, it's completely up to you. But what do you think?
Can you hear me? Can you hear me still? I think I might have dropped off one.
You froze it exactly at the right time.
What do I think about peer-to-peer? So I've always loved it as an asset class. I've never had serious amounts of money personally. So before joining Plend, I was basically an accountant. And I was, always put some money aside, different things, but never sort of had substantial amounts where, even the IFISA tax relief really benefited me substantially. But what have I put money in? What am I being excited about? The shame is, what I had money in, most of them have been either bought out or stopped peer-to-peer. So I've had money in Funding Circle, Rate Setter, Assets Capital, have all since sort of been wound down or being wound down as we currently speak. I've got money in Mintos, which I still rate, even though some of those assets haven't necessarily performed the way that they should have done. And I do think there's a space for that aggregator peer-to-peer platform akin to the Mintos, where what are you good at? What's your specialty in this market? And it's either managing the retail side and managing those funds, or it's managing the origination, the actual creation of the asset. I don't know. Doing both is hard, and I'm curious in the future there, and I'm going to do a shout out to one new platform starting in the UK called Dark Square Capital. You may have heard of it. If you haven't, look them up. They are trying to do something similar to Mintos in the UK, but in some pretty wacky asset classes actually, but pretty exciting ones. Can I say that Plend will be on that platform? Possibly. It is retail. There's going to be some cool stuff going on there. They've got some really, really cool assets. They're a very, very good team, and they're very good at finding those sort of originators. But there are assets there that are like forestry, for example, and also some wacky ones around kind of NPLs. We're going into a bit of an interesting time economically, and there are these kind of loan books going around there where you could actually recoup some value from them.
What's an NPL, Rob?
Sorry, non-performing loan.
Okay.
Essentially, it's akin to what you'd call special situations, but it's where generally a credit fund or a hedge fund might buy a book from a failed lender. There's still good loans wrapped into that loan book, and essentially you're trying to buy that at a discount and then recoup above that price that you paid for it. And you can make a lot of money. You can make 2-3x if it goes well. If it doesn't, then it's not great. But essentially, there's a play being made there, and there's definitely that asset class is going to get more interesting over the next 2 to 3 years. We're hearing some noise now about commercial real estate. I don't know whether it's true or not, but there's definitely some pressures and cracks beginning to form in the financial system. The recent bank runs in the US are an example of people being a bit jittery, and obviously flows of capital can move a lot quicker now. We've definitely got to a point now where whether it be depositors pulling out from a bank or investors pulling out of an asset class, the movements of capital can move very, very quickly, and also offline as well. They don't necessarily need to be via a trading platform. Just an example with Silicon Valley Bank. Plend had some involvement, or we banked with Silicon Valley Bank UK.
Did you really? Yeah.
We did. Yeah. We were there. I knew a lot of people that did. It was about half the fintech sector had bank accounts with them. Wow. They were a great bank. They understood us, and they wrote some good business. That bank especially, they were ring fenced and had a really good healthy position. But what I was going to say with that is there was a lot of opportunity offline that popped out of that, where essentially there were hedge funds and special situations funds that basically were offering to buy the deposits off companies like Plend at a discount for like 80% or 90% of the value. They're assuming that we're going to recoup most of it back, but operationally, a lot of companies like Plend needed the cash now to pay for payroll and costs. So we were going to take a 10% discount on our deposits for cash now. And that these types of opportunities are going to, I personally believe, are going to be popping up all over the place. And there's some really exciting opportunity there it's not like The Big Short, sort of come to 2008, but I think there's similar things like this popping around where, there's definitely going to be some assets, distressed assets that can be acquired and acquired at a good price. So, going back to my original thought, aggregators and P2P, I know it's not technically a peer-to-peer platform, but I think it sort of creates a similar effect, and I personally think there'll be some interesting stuff going on there, and that's where I see also Plend listing its sort of retail opportunity is on platforms like this, where we're sort of taking away the administration of the retail piece, and we're providing what is a robust asset class with guarantees and securities attached to it, like most of these. I know I don't know if you're still with Mintos or not, but most of them have still got some form of security pack structure there. An institution might be in there as well, so there's some security. You might be the senior ranking in that loan. So there's some pretty good assets that you can find there with some pretty good protection. So I'm excited about that going forward. But would I recommend a platform at the moment? Probably not. It would have been assets actually.
I was going to ask you, what did you think when that email came through about Assets Capital?
I mean, it was interesting because I remember when they jumped on when RateSetter had to close the doors. Actually, sorry, Zopper. Was it Zopper? Maybe it was Zopper, sorry. And they really pushed it. They were like, they were going to be the biggest UK peer-to-peer platform remaining, and they were always going to stick to peer-to-peer and be the kind of the flagship for the industry and keep it going. So it was a shame to kind of see them make that transition. Does it make sense? Probably yes. But yeah, I always find it difficult because peer-to-peer is technically an asset class for investors, but it's not really an asset class because the asset is the originated loan, and it really differs from property to business to consumer. That we're not actually all the same. We're completely different, and there are different pressures and different things going on, different financing sources available to us, and peer-to-peer becomes a sort of one of those financing sources in many of these cases. So did it make sense for the direction they were going? Probably yes. But it's a shame because they'd made a big song and dance about getting us all in, and then unfortunately it wasn't going to be the case going forward. So yeah, aside from assets, I don't have many other thoughts on the existing players. I do know of them. And I think there's still some good ones popping around, like Shojin, for example. I do have some exposure to, but they're a bit more high net worth. And I think there's a transition now going towards, because of the financial promotions restrictions in the UK, especially for UK platforms, edging more towards being a bit more unsophisticated and targeting sophisticated investors, or at least convincing retail investors that they are sophisticated in order to access the asset class.
Yeah.
So that's a very controversial thing to say. So I hope the FCA didn't hear that. But I think that's sort of where things are shifting anyway. That change in financial promotions regulation is pretty damning, really, for most retail investors.
There's a couple of questions that popped up in the chat here that I think are pretty interesting. From Peter Vince, he said, who else can see our banking transactions? Just you, or do you pass it on to anyone else? So I guess that's through the open banking. Can you see everything that's going on with somebody's banking transactions?
You absolutely can. It is a pretty intense process. You know, you're laying everything bare to someone like Plend to review. What I would say there is, can anyone else see it? No. So the way it's heavily regulated in the UK, there's no ability for us to share that data, and we have to delete it after 30 days. So it's actually not, well, it's useful to us to some point, but we don't actually get to keep that data for any further analysis or anything like that. Which is it's actually frustrating for a few players who I think would like to have that data for longer. But no, it's not used for anything else, and I'll be honest, I haven't even thought about trying to sell it because I don't even know where I'd do that, but we can't currently. We don't have the status to do that. So, but does it reveal a lot about a person? Absolutely. And that's also why we use it. We use it because we want to understand if you're gambling and how you're spending money and those vulnerabilities. It's the brutal honesty of this asset.
Is a lot of people doing that? Is a lot of people losing money on the ponies? Is that what's going on? The
biggest decline reason for Plend is gambling. It's
really?
About 25% of all of our, and you don't get that from the credit bureau. So that there is an instant win compared to using credit bureau data, because that's a big chunk of customers that you just do not know what they're doing with their funding. It's not that I'm against gambling. We do have tolerances for it. We do allow a certain amount of gambling activity, but when it's a certain level of your income, or a certain percentage of your income, we have some pretty hard cutoffs where we can't take the product forward. But yeah, it's a pretty personal picture. I mean, we're not doing it to shame anyone. It's, the way we underwrite credit at Plend, I should probably say, is that all of your personal information is anonymized. Now, that's not always completely helpful because your transactions might have lines where you've transferred money to yourself.
Yeah.
And we sort of can't unsee that. But if someone was to go into your file and look at your application, everything we do is automated. But if we look at an individual application, we couldn't look at your name or your address, for example. We wouldn't be able to actually know who's behind this account. So we try to kind of mitigate some potential human, bias. Any kind of unconscious bias that we have as individuals looking at someone's credit file, looking at someone's transaction file in that process. We try to basically remove that. It was a really important part of our process. Not everyone does that. I think most lenders who use open banking probably see your name in any credit application, but in our case, we wanted to make sure your name and your postcode at the very least weren't relevant to making a credit decision. That was fundamental for us early on. But yeah, we see a lot, and we see a lot on purpose. We need to make a decision.
That makes sense. Another question. John Day says, can you say which other peer-to-peer platforms may act as a front end for Plend in the future?
Good question. I mean, it's pretty obvious, maybe. So this platform launching in the UK, Dark Square, we're definitely one of the solutions to be listed on there, or one of the products to be listed on there. So that's one to look out for when that goes live. The only flag with Dark Square is you have to be sophisticated. So technically, when you go through the certification process, you have to make sure you satisfy those requirements. There are 2 platforms in Europe that are aggregators for this, and we are launching on both of them. Not all at once. There's one this year and one next year. But those 2 platforms, I'm pretty sure you will see us, and it will be announced publicly as well. We won't keep that quiet. There's still a bit of DD and stuff to be done there, and we have to also pass up the loans as well, and basically sell them off to this platform or list them on the platform. So there's a bit of work to be done there, but that's where I see that retail piece opening up.
Might that platform begin with an M and end with an S by any chance?
No comment. I'm sure there's someone looking out watching this.
No, you don't have to
my answer to that is we would be idiots not to list on their platform, just given the sheer number of customers.
Well, you can't invest in the UK anyways if you're a UK on Mintos now. So
that's correct. But there are plans to bring that back. So keep your eyes out. I think they've
been working on it for a while.
They've been working on it. Yeah.
All right. Yeah. So let me ask you a general investing question. So Rob Pasco is not the head of Plend, right? This is obviously theoretical because you are, and he's got 10 grand in his hands. Where's he put that money to invest it today?
Rob Pasco right now. Okay. So I've worked a lot in fixed income prior to Plend. So I would take some fixed income exposure just given current bond prices. There are definitely some interesting assets currently, and rates probably. I don't think interest rates have peaked, but interest rates are probably getting close to a peak, and therefore buying bonds at this this price is probably not a bad idea, given where if interest rates drop again, the values of those are going to skyrocket. And there's probably a little bit of distressed, or not distressed, but sort of assets at risk that I would invest in, like that. I'd put a little bit into the share market. I actually, personally, I'll be honest, I'm a little bit exposed to the current regional banking situation in the US. I'm making a few bets personally that some of these are going to pay off. This is not investment advice. Please,
never.
Everything I say, I have to be very careful. I'm bloody FCA approved person. I have to be careful what I say here. But no, I've got some bets in the US, especially because, I mean, I don't know where you politically stand, but unfortunately, you know, the government will never let a bank really fail ever again. So, you know, there's always value to be made from some of these assets, even if they're run badly. And then in peer-to-peer, what would I do in that respect? I've got some Mintos exposure, so I'd probably increase that a little bit. There's not one asset that I would go. I mean, diversified portfolio. I'd never go into one thing completely. But there's definitely some exciting things going on. And when these kind of more special situations, opportunities pop up, like with Dark Square, I would definitely have my eyes up for that. I think there's some pretty cool stuff going on. And those are the types of assets which already exist and have already been invested in by tons of investors and hedge funds and other groups. But it's been very rare to get it available to retail or quote unquote sophisticated investors, because, well, the bare number of funding you need to buy those assets is generally upwards of 150 grand, 200 grand, just to get any exposure to them. So I think there's some innovation coming that way, and I'm very excited about it. And there's the big C, crypto. I'm personally never really been into that much. A lot of my team are. So I will not say anything on that because it's
No,
I haven't
I
got any views on
understand.
it
No, I
at this
understand.
point.
It's a tricky sector for most people to understand. I mean, somebody in the comment just said, "Pump some into low cap altcoins," which yeah, that talk of like that's nitro fueled investing right there. But no, I appreciate that. It's something that I like to ask people, because there's a lot of people sitting on the sidelines right now that are very concerned about the equity markets. They don't also understand about the bond markets, how they think, well, interest rates are high, so bonds should be doing well, but actually it works invertedly. So when interest rates are high, bond values actually drop. So I think it's an interesting way to kind of get a feel for people in the financial world, how they would just take a substantial amount of money and put it into an investment right now. But little birdie tells me, who is a good friend of mine over here, who works on Wall Street, said that he sees a lot of money flowing out of the regional banks into the big banks because people are scared. And yes, while the government will likely not let these banks fail, it doesn't mean that they're going to necessarily perform well, because if deposits are shrinking, the banks can't necessarily be more profitable. So it's an interesting take on it, and I can understand it.
It's a big bet that I've made personally, and actually I made a side bet with a friend in the office, because yeah, it's a good point. My big thing with this is the assets owned by that bank or those banks haven't changed. So unlike 2008, where they were sitting on tons of toxic, overvalued MBSs and CDOs and everything like that, what we've got here is actually some quite good business that's been written by these banks. And in the case of Silicon Valley Bank, they weren't covering their position in interest rates. That's stupid, and that's on them and their management. But in the case of some of these big regionals, they're actually pretty good. Now, there is obviously a pressure point, as you say, with deposits dropping. They're going to have to sell some of those assets and probably at a discount to other banks in order to basically pay back those deposits. There is risk there, but I still think there's some good margin to be made based on where they're currently priced. Sorry, not investment advice. Do not do this now, personally.
Don't do it.
But I mean, for example, like First Republic, the jury's out there where that's going to go. I would avoid that at the moment. But the other ones, I mean, what I experienced personally with Silicon Valley Bank in the UK, I didn't have any US deposits, but in the UK, we were a highly networked, concentrated deposit base. We knew everyone. We're all backed by the same VCs. There's like less than 1 degree of separation almost in reality between us all in the same WhatsApp groups and the same, Slack groups and whatever else, the way we communicated with each other. So the pace at which funds moved was dramatic. It was crazy. In the UK alone, it was 3 billion in about a couple of days. In the US, it was far greater. But what that did, obviously, even though the bank had fantastic assets in the UK, they'd written some really good business, and they had actually a very healthy balance sheet. I mean, it doesn't matter when deposits move that quickly. There's nothing you can do about it. So my feeling with the banks in the US, if the noise drops away and that fear and that panic begins to subside, maybe they've got to entice those depositors back with some high interest rates. I don't know. But the assets are still there. If they don't sell the assets, then I'm happy, and maybe there's something to be made back. So gosh, I'm going a lot into this in real detail. I should be focused on Plend and not talking about, my sort of take on the regional banking market in the US. But I'm quietly excited about where it might go. Basically, is my view.
Yeah, I understand.
Lawrence, in a month's time, I'm going to be crying and it'll all be lost. And
whenever you say you've made a bet, it concerns me. You'll not be able to borrow money from Plend if you keep making those bets, because they're going to check you out on open banking and say, this guy's gambling.
Well, that's a good point. So we've had that challenge internally already around crypto, and whether we negatively weight that for risk. It is a challenge. Like what we've unlocked, we've realized, is some serious insights on an individual's behavior, but we don't necessarily know if that's good or bad. There are some easy wins, like having a job, for example. That's great to know. Great to know whether you pay your Amazon and other costs on time, you pay your Netflix. Actually, we found that the biggest correlation to positive repayment, and this just might be, what is it, causation or correlation, whatever, one or the other, it might not be actually completely right, is having a gym membership. If you've got a gym subscription, everyone that's paid on time and has been very good with all their payments has had a gym subscription. And I kid you not, everyone that hasn't has missed a payment at some point in their life.
Why do you think
Now,
that is?
I don't know.
Maybe they're just mentally healthier, or physically healthy.
Mentally, they're paying everything on time. They've got they're more organized with their life financially. We don't know. This is for us to work out. This is what we're basically building here, is these serious amounts of insights that we can then start building some correlations with on performance, how these loans are actually really going in practice, and what were the factors that actually made them go right or made them go wrong. And that's the big play with Plend as a business. So there are a lot of things like this, like crypto and this gym spend piece. I couldn't tell you whether it's going to hinder or help a product, but I hope in a year or 2 years' time we will know. And that's what we're trying to do: collecting that data, putting out some loans, a good substantial level of loans behind that data, and then when it starts to see some seasoning in that book, we can then make some really exciting decisions or some really exciting additions to our model, which will turn the dial dramatically. That's the exciting part. But I don't know otherwise. Apart from that, there's some really wacky things that we find all the time. We just don't know at this stage.
Do you think that obviously a lot of peer-to-peer lending companies are doing property lending? Are they able to use this open banking to better qualify their borrowers, or are they already doing that or not? Because I haven't heard too much about open banking being used the way that you speak about it.
Yeah, absolutely. I think, I can't remember if Market Finance is actually a peer-to-peer still. There's a lot of ones where they think they were peer-to-peers and they're not anymore, and I can't remember where they are in that journey. But there are some platforms in SME and also property that are doing open banking checks, either in the case of commercial, it's checks on the directors. So you get a lot of information from the directors and how they live their lives and how that correlates to the performance of the asset. And the relation to sort of more residential, I mean, you obviously need that information. It's vital. There's other factors at play. Obviously, there's an asset you're financing, i.e. the property. So there's other kind of, origination. So work you need to do in underwriting that risk. So it's not a simple like silver bullet. It's going to change the game dramatically, but it helps as a tool. I think some platforms have moved or are moving this way. There's been a lot of I was at the P2P Finance News last year, and I'm pretty sure a lot of platforms I met were talking about it or have already adopted it. And there was even a category, I think, in the awards for like open banking or like smart data provider of the year or something like that. There's definitely, there's a lot of smart people in the industry. A lot of them are looking at whatever tools they get their hands on. And it's not always going to be open banking data. There's other things that you can do. We're looking at integrating, for example, right now, overseas credit files. So if you move country, you might have a great job in the UK, but we can't find a UK credit file. We can maybe check for a Turkish credit file or a US credit file. And that allows us to still give you a product. So there's other data points that we're looking at too. And I think every P2P, every lender is always looking at new data points to improve their processes. So I'm sure, and I'm more than sure that some property platforms have started using it for part of the process.
It makes sense. I mean, maybe we should be using it as investors to do checks on the people running the peer-to-peer lending companies.
Yeah.
Yeah, because we've had some directors that have blown everything up through their terrible habits.
Sort of akin to politicians putting their tax returns publicly.
Yeah.
It can be a similar request. Every director puts their open banking history publicly or something like that.
We had a couple of people in the chat said, I don't have a gym subscription, so I'm proving exception to the rule. And then another one said, I don't have a gym membership, but I don't have any loans either. So there you go. Maybe that's the key.
There we go. Yeah, absolutely.
So is Plend profitable at the moment, or are you sinking the money back in to grow?
It's a good question. Are we profitable? No, we're too early on in the journey to hit profitability yet, but we're very, very close. I can't announce anything yet, but we hit our first like big commercial milestone, which was like $1 million in revenue about 2 months ago, and I'm fairly confident we can at least get the platform to break even in the next couple of quarters. And then after that, it'll be covering all the kind of R&D costs and everything else that's ancillary to the business. But no, we're not quite there yet. No, that's
How does it work for you as the guy running this, right? So you obviously have to eat and pay your bills. Your platform isn't profitable. How do you figure out what you're going to get paid? How do you get paid? How does that work?
It's a great question. It's actually not my choice. So we've done 2 rounds of VC funding now, and physically my contract gets. I say physically, my contract and the contract of my co-founder gets written up and offered to me from the board, which is VC dominated. So they ultimately decide what I get paid, how much holiday I get, and things like that.
Do you get to negotiate that out, or is it pretty much this is what you get? You either take it or leave it.
It's a good question. I have actually heard of some founders literally threatening to walk away if they don't get a certain pay increase to their boards, because there is some key man risk there where you could just be like, well, fuck it, I'm not gonna. Sorry, I didn't swear.
We're not swear away.
we're not gonna continue and let's just pay us an extra 10, 15 grand more. So I haven't done that. My relationship with my board is good, and but I mean, obviously you've got negotiating power in that respect. How does it feel otherwise in terms of running the business that's not profitable? I mean, like it's a constant pressure point, but I think what differs us from prior platforms that were VC backed, because not every P2P has been VC backed, and that's probably for the best. If I'm honest, there's a lot of different pressure points you get from VCs who want to see 100x growth and become a unicorn in 1 year and go out and dominate the market overnight. But in our kind of circumstance, we got regulated during the first big energy spike in the UK in April of last year. So we were in a very tumultuous time. We had to be very, very careful about our initial loan book, put a lot more restrictions on early on just to be safe. We didn't want to go a bit too crazy. Year before that, our VCs were like, go out there and conquer the world. But the time we actually launched our first product, we were sort of in a time which was being defensive and being careful. So we run a very, very small team relative to our size, a very efficient team in terms of capital usage. So there is definitely a priority for us to hit that break-even point, at least as a platform. When I say platform, I mean literally like the operations of this, all of our costs and our salaries, hitting that break-even is absolutely vital. And what it does, it's not necessarily it's been pushed on the VCs or my board to do this. I mean, obviously it's nice to be profitable, but why I want to do it, and why it's important to plan to do it so early on in our journey, is so we have a bit more negotiating power and stability going into whatever the next 2 or 3 years looks like. We might not be able to raise external funding at the same rates or the same levels in the future. Even if our book performance is fantastic, it doesn't really matter if the market isn't there and interested in investing in the business. So it's really important in my end to get this business to profitability this year. So we don't need or are not forced to raise capital or take ridiculous terms. And it has killed some platforms. I mean, there is a big one, rate setter we all know of, where essentially this became an absolute issue for them and they couldn't raise capital and they did a sale. For many different reasons, and I don't want to get into the details there because I don't know all of them either, but essentially I don't want to be in a situation like rate setter was, and I don't want to be in a situation like many platforms where you end up being desperate.
Yeah. And
you can't control your cash burn. So it is vital for us to get that right early on.
So we'll ask you one more question and then we'll let you get out of here because it's getting late. We're already going an hour and 15 minutes. So I love picking your brain and it's fascinating.
Sorry for talking so much, Lawrence.
No, I enjoy it. It's great. I get to really, ask you some very honest questions and you always give me very honest answers and I appreciate that. For the person that still is looking to get into peer-to-peer lending, he or she has seen the tumultuous past of what has happened with these companies that failed. What advice could you give somebody on how to pick a reputable peer-to-peer lending or, say, investment company to put their money into moving forward? If they were, say, a complete beginner or somebody that's not very advanced in their investing journey, how could they pick some reputable companies to invest money through? Just a couple of general tips you could give.
Yeah, no, it's a good question. And I'm definitely not the expert here, but I will say if we're thinking about the UK in isolation, which is only my experience, the regulatory environment has shifted a lot over the last 3 to 4 years. And it's been very harsh, and it's probably clipped the wings of the industry in many ways. But what it does mean is that the remaining platforms that exist today are very, very robust. They get a lot more scrutiny than any other kind of investment platform does. They are deemed, technically P2P is deemed in one of the highest risk categories by the FCA, unfairly in my opinion, because it's actually there's some very, very good asset classes. A lot of them are secured assets, i.e. property. We've actually got a good security over those assets. So the regulation there is sort of very harsh. What that means is that the remaining platforms have high quality. Now, pinch of salt there, because while they might have high quality around their procedures and processes, there are still the same challenges like any investment platform around running an efficient business operationally and having enough cash to actually deliver what you said you're going to deliver. So I would probably suggest in the first instance is doing some serious DD, or not serious DD, but a substantial DD on at least the finances of the platform that's offering their solution. So, looking at the rates, of course, are important, and looking at the performance, but also looking at, is this platform able to exist in 2 or 3 years' time? Do they have the cash requirements to actually meet those requirements? Because an example of this is the FCA have increased the requirements for P2Ps around wind down reserves. What this means is basically we have to put aside a pot of cash that we can't touch, and that gets activated if we run out of cash and we hit that kind of pot. That pot's the remaining money we've got left, our reserve. We have to stop trading and wind down the platform. So it's important to understand how insulated a lot of these platforms are from hitting that wind down reserve, and how protected they are from doing that. So that's absolutely vital. And then obviously there's the sort of standard stuff around, reviewing the assets they're writing, understanding the origination process, and then obviously past performance, not an indicator of future returns, but it is useful to understand about what they've done. And if they've got a track record, always a bonus, absolutely. But I will leave my statement on. I do personally believe P2P, I don't say it's an asset class because there's different assets behind each of these platforms, but you get access to an asset class which is pretty exciting, and it is still unique and still lucrative. I mean, there's a reason why banks are the ones normally funding these, or credit funds or institutions, because they're good assets. They're earning good yields from them. And provided you've got a good management team who's running and operating those platforms, there are some really, really good returns to earn from it. It's not exciting. It's not asymmetrical. It's not going to 2x or 3x, but it's reliable. It's fixed income. It's a decent product to be in, provided that the platforms are stable and they can deliver. And your way of doing that is reviewing, sort of how much cash we've all got behind the scenes, underpinning those businesses, because it has become a lot harder to run a P2P in the UK. I'm not going to lie, and everyone I'm sure has been on here said the same thing. And the restrictions are only getting worse, but it just means that the players that are left are pretty strong and pretty stable.
They have to be.
Stable.
Yeah. Good advice there from Rob. I appreciate that. Okay, so wrap it up. Just to kind of summarize, so for everybody that maybe came on late or is watching it in the future, that Plend so far is not a retail peer-to-peer lending company, and they will maybe possibly be doing something in an aggregated format through other peer-to-peer or other companies that may be offering buckets of loans and things like that. So currently you cannot invest, but if you do need a loan, you want to borrow some money not to gamble, because we should never do that, go check out Plend's website, because I personally would say if I needed to borrow money, I would prefer to go to a company like Plend than I would go to a bank or a ruthless credit card company, because I'm not a big fan. So check out Plend. They've got some great, and I think you can get approved pretty quickly, right?
Yeah, normally the average loan gets approved within less than an hour. We try to do it less than that, but right now it's about an hour from approval to payment of funds.
Perfect. Okay. So there you have it. Anything else you want to say before we wrap it up and go on our merry way?
No, just an absolute pleasure to be on this platform, Lawrence, and also just to keep you sort of following our journey. from sort of day one has been amazing, and your support has been amazing too. So appreciate being here and giving me letting me talk. Probably too long and probably too detailed. I'm sure either the FCA or my competitors or my team are going to tell me off at some point. But I appreciate being able to chat freely.
You're fine. You're fine.
I
think if the FCA was watching this, I'd be pretty proud. But unfortunately, I don't think I've hit the FCA's radar yet. But thanks again, Rob. We'll definitely have you back on in the future. And best of luck with Plend. Keep doing what you're doing and change the borrowing business, because you're a good guy and I like to see you succeed. So
thanks. I'll do my best, Lawrence. But yeah, especially if we launch an aggregator, I'll definitely give you guys an update when that finally
absolutely
happens.
Okay. All right, well, have a great evening and we'll speak to you soon, Rob. Thank you so much.
Fantastic.
Okay,
thanks, guys.
Bye.
Nice to meet you. Cheers.
Bye. So there you have it, Rob from Plend. I was hoping, to be honest, to hear that Plend would offer retail peer-to-peer lending. I had a feeling that probably wasn't going to happen because I knew how much business they were writing, and he said he's done over 107 million. And originations, obviously, he doesn't need the retail side of things. Plend doesn't need the retail side, but I wanted to ask him anyways to find out what was going on. And oh, look at that! She's having a snooze. I really like this camera. Tell me what you think. Is it silly? I like having a little Harley camera. It's one of my favorite new things. It's kind of goofy, but there you go. But listen, we have a lot of really good guests coming up in the next few months, including we have Folk to Folk, Capital Stackers. We have Susie from Peer-to-Peer Finance News, who I read their website constantly for news. She's going to be coming on, and we're talking peer-to-peer lending too. So a lot of really good guests amongst other people. I think Assets Exchange will be coming back on Peter Reed in the next couple of months, I believe. So yeah, keep coming back. And again, I appreciate your support. Thank you for tuning in every Thursday, and tell your friends and family about what's going on if they're interested in peer-to-peer lending. Just let them know about Financial Thing, about the channel. It just really helps me out a lot in getting this information out to people and getting our sector the exposure that I think it needs and deserves. So again, if you consider becoming a Patreon subscriber, down there you can scan it. There's a link in the description below. And this is not it's not a permanently streamed camera, because I don't know that she would like to have a camera on her permanently. So, but it is a live camera. I guess it kind of looks like a photo of her just sitting there. But no, it is during the stream, she will become a fixture of the stream in some way. I haven't quite figured out how yet, but she's such a cute little thing, and I love her to death. So she's turning 7 this year, so getting a little older, but there you go. Anyway, we'll wrap it up. Thank you again for joining. We'll see you next Thursday, all being well, and appreciate every single one of you. Have a great weekend. Enjoy yourselves. We'll see you next time. Take care.